Hi, welcome back to this course on infrastructure finance. This is lecture 34. We will continue our discussion on risk management, specifically with the focus on country and political risks in this lecture as well. And before we actually go in more detail about the country and political risk, in fact, if you remember, we had an initiation to this topic in the previous lecture, and we will try and continue the discussion in this lecture as well. But before we do that, let us try and spend some time to talk about these thought questions that we actually had at the end of the previous lecture. We had two questions. The first question is political risk a concern only in the case of a foreign investment? Okay. Before we actually try and discuss this question, I wanted to give you an example of about what is political risk. Okay, because political risk is a very broad canvas, and then there are so many things which can actually be clubbed under political risk. So, to help you to understand what is actually what can be actually called as political risk, let me give you this example. In the early 1990s, when India actually went on a path of liberalization and reform and so on, many of the infrastructure sectors which were once reserved for public sector investment were thrown open for private sector. So, one of the first sectors that were thrown open was the private sector, and specifically power generation. And the first large private sector investment that happened in India was for a power generation project which was situated in the state of Maharashtra. So, this project was being promoted by a company called Enron, which at the time was one of the world's largest energy company. Today the company it does not exist in a significant way. But Enron was a leader in power generation at that point in time, and they actually got a mandate to set up a large power project, more than 2000 megawatt power project in the coastal part of Maharashtra. And the total investment at the time was worth about $2.8 billion, and close to about 3000 people were supposed to be employed in the project doing the construction, and subsequently when the project was being operated as well. And the project was supposed to be in two phases. The first phase about 600 megawatt generation capacity, and in the second the remaining about 1400 megawatt capacity. And in 1995 when the government, the state government actually changed. So, initially it was the Congress government, and then subsequently in the second half of 1995 a new government took over office after the elections. So, when the new government came into the picture, they actually cancelled the contract, indicating various reasons. The first reason that they have cited was the project was being awarded without any competitive bidding. Remember, at that point in time when India was opening up its country for private sector investment, there were a lot of concessions that were needed to be provided. So, over a period of time it became mandatory that large investments would have to be awarded on the basis of competitive bidding, but the initial few projects were supposed to be with the objective of giving a proof that India is open for private sector investment, and they were not actually awarded on the basis of competitive bidding. So, it was more of a discussion, it was more of a memorandum of understanding that was signed between the government and the investor, and based on that the permission was or the approval was granted. So, this was cited as a reason for the cancellation of the project contract by the state government. So, the actually cancellation happened two things. One is the first phase investment of about 600 million, which has already occurred, and in the second phase which was yet to happen. So, the state government cancelled the second phase of the contract, citing that the project has been awarded without any competitive bidding. And the first phase of the project, for which a power purchase agreement had been signed as well with the Maharashtra State Electricity Board, was cancelled, citing the tariffs were very high. So, all of this in terms of the higher tariffs are all this known even at the time of signing the contract as well, but all of this became an issue because of the change in the political government at the state level. So, this essentially was precipitated because of political risk, because of a change in the government. It is not because of any of the other reasons that one could actually think of. So, this is a good example of how political risk can actually affect the infrastructure projects. And then in addition to cancellation of the project because of higher tariffs and so on, there were also questions about the environmental concerns of the project. Okay, so there were a lot of movements both at the local level as well as the state level, citing severe environmental impacts that could occur because of the project, and that again is also an outcome of the political risk. And so the entire project at the end of the day becomes so mired in a lot of procedural and legal problems, and ultimately it was a very severe setback for the investors. Okay. So this is an example of political risk. So the question is, in this case of Enron, we actually had investors from abroad. So we had Enron, we had General Electric. These are all companies which are based in the West. And did the political risk come about because of foreign investment? Had we actually had complete investment from the domestic investors, would we actually had political risk? So political risk is immaterial of whether the investment is coming from foreign or whether the investment is coming from domestic. So there are several instances where even investors, if they are from the private sector, they actually had to suffer because of the political risk. One famous case is a toll road in Karur, which actually had to be which was taken over by the government from the private sector following a change in the government. So in this case there was no foreign investor involved, it was more domestic investment. The road was actually developed by Larsen and Toubro, which is in more than one sense considered to be a domestic company, but still because of the change in the government the project was taken over by the state government. And then obviously there was some compensation given, but the compensation might not be adequate to meet the expectations of the private investors. So therefore the risk is largely an issue against private sector investment and private sector profiting in the infrastructure segment. It is little bit higher in the case of a foreign investment, but we cannot say that the political risk is completely absent when you have only domestic investment. Now let us look at the second question. Is political risk seen only in developing countries, or do we actually also see some shades of political risk in fairly developed countries as well? So the answer to that question is there are different types of political risk, and one of the segments of political risk is actually called as a change of law risk. We will deal about some of this in today's lecture as well. So when you consider about change of law risk is essentially prevalent throughout the world. It is not only an aspect that concerns only developing countries, and particularly Finnerty in his book mentions that US probably actually has the highest amount of risk because of changes in law. Now changes in law affect the project in many ways. In most cases environmental regulations are changed with retrospective effect, that is, even existing projects will actually have to comply with any changes in the environmental regulations. So this actually creates affects the project, and it can actually be seen as one of the political risks. So there is one example that Finnerty cites in his book, which is actually the Boyne Valley Power Authority. This is actually a government owned authority, and it has actually signed a contract to purchase power with a power plant, and on the basis of this contract private investors have invested in the construction and development of the power plant. But midway through the construction, apparently the authority, which is actually the arm of the government, pulled back out of the contract, saying that its customers have walked away from the power contract because they have been able to find cheaper sources of power, and because its customers have walked away, it is not able to honor the power purchase contract that it has signed with the project company. So this is actually in some sense a government authority not honoring the commitments and the obligations of the contract, and this actually happened in a developed country, which is the US. So therefore we cannot really see political risk as being prevalent only in developing countries. It may be relatively higher, but we can also see political risk even in developed countries. Okay, with this we will actually look at today's lecture, which is to discuss a little bit more about political risk. First question is, can we actually classify political risk? Yes, we can actually look at political risk under various categories. Broadly we define political risk as under three categories. One is the investment risk. So, investment risk basically is a unwillingness or the inability of the host government to fulfill the obligations of the government support agreement. In most infrastructure projects, what you actually have is there is a government support agreement where the government clearly indicates what is the kind of support that it will be able to give the project company. Now, and generally in most circumstances the government signs this agreement with the objective of attracting private sector investment, but in the future if for some reason or the other the government is unable, one is it is unable to actually honor the obligations of the contract, and the second is even though it is able to, it would be able to honor, it is unwilling to honor the obligations of the contract. So, in both these cases the investment risk is prevalent for the project company. The next is your change of law risk. Okay. When there is a new law that is being instituted, or if there are changes to the regulations under the existing law, it can actually affect the viability of the project. So, this is basically a change of law risk. Law making is essentially a political process. So, therefore, this change of law risk can also be considered as an element of political risk. And then you have quasi political risk. Basically these are issues that might either have a political or a commercial background, but it is going to be very difficult to distinguish between these two. Okay. So, therefore, these are all probably problems that has a political connotation, it probably has a political background, but it makes it very difficult to distinguish whether it is really a commercial risk or it is a risk that is arising because of political reasons. Okay. So, each of them has certain specific features. Now, we will look at each of these three categories one by one. First, we will look at investment risk. Investment risk can be considered under any of the three categories. It can be due to currency, convertibility and transfer. Let us look at currency, convertibility and transfer. How will this risk affect the project? So, normally if you look at a project, particularly in the infrastructure projects, it needs a lot of investment, and the domestic capital markets are not in a position to finance the entire capital requirements of the project. So, this is something that we have looked at earlier. So, therefore, the projects look at attracting private sector investment. So, when you actually attract private sector investment, the investors are based abroad and they will have to be given returns based on the revenues that the project company generates. So, in most cases the revenues are generated in the host currency, but it has to be converted to a foreign currency before it can be repatriated to the investors abroad. Okay. So, how does this work? So, we have, let us say, the project company, and then the project company gets, let us say, revenues in domestic currency, revenues in domestic currency. And this domestic currency cannot be directly used to pay the investors because the investors are abroad. The investors need to be paid in foreign currency. So, therefore, the domestic currency needs to be first converted to foreign currency. So, how will the domestic currency be converted to foreign currency? So, for example, you will have to provide, let us say, project company gives a domestic currency to the government or any particular arm of the government, right. So, let us say this is your government, and then the government in turn gives what is called as your foreign exchange, right. Government gives your foreign exchange. And then the project company transfers the foreign exchange to the overseas investors, right. This is your overseas investors. Now, there can be problem, there can be a risk in two places. One is if the government is not in a position to convert the domestic currency to foreign exchange. So, this is your currency convertibility, right. This is your currency convertibility. If for some reason the government prevents control of domestic currency to foreign exchange. And then the second is your transfer. If the government prevents transfer of foreign exchange leaving the country. Okay. So, if the government prevents either of this from happening, then the project company will find it difficult to service the investors, right. So, this essentially is what is called as your currency convertibility and transfer risk. So, when can this actually happen, right? It can actually happen if the country gets into economic difficulties. Okay. So, because of economic difficulties, the government is running short of foreign exchange, and the foreign exchange is needed to procure goods and services that are essential for running the country. Okay. So, the economic difficulties forces the government to use foreign exchange for much more urgent needs rather than paying the project company. Second, there is a shortage of foreign exchange. Foreign exchange reserves are not adequate for it to be paid. So, in both these cases these problems can happen. Sometimes currency convertibility might might be hampered when there is a devaluation. So, when the project was started, the exchange ratio had a particular level, but somewhere during the project operations the exchange ratio was completely changed because of catastrophic devaluation. So, in this case also the foreign government the domestic government will find it very difficult to honor the currency convertibility and transfer. Let us say for example, for a particular level of foreign exchange after a devaluation means you need to have a lot of domestic currency. So, it is actually going to put pressure on the government in terms of currency convertibility. So, how do the investors mitigate this? There are various ways investors can look at mitigate it. One is the most often cited approach is basically called as enclave projects. Okay. So, when you actually create an enclave projects, what essentially are you doing is the revenues of the project do not come to the host country, right. Let us say for example, you have a project company, which exports its products and services, right, which exports its products or services and to the markets abroad, right, to the markets abroad. We have markets abroad. Now, when it actually exporting, obviously the revenues are going to be coming from the foreign currency, right. So, the revenues will come from the foreign currency. So, in a normal project the foreign exchange revenues, right, foreign revenues will come to the project company, correct. But in the case of an enclave project, what is going to happen is instead of the foreign revenues coming to the project company, it is actually directed to an overseas account. It is actually directed to an overseas account right, and this overseas account is used to service investors, right, it is used to service investors. Okay. So, we do not really have this link of foreign revenues coming to the project, right. So, this is created in a separate overseas account, and because of the fact that it is an account that is abroad and it is an account that actually has foreign currency, the issue of convertibility and transfer out of the host country does not arise, because the account itself is outside the foreign country and the accounts are based in a foreign exchange, in a foreign currency. Right. Whatever remains after the investors are being serviced can be brought back to the host country into the project company. So, this is an enclave project. So, normally this strategy would be adequate when we actually exporting the products or services. So, that means the commodity is actually in a position to generate export revenues. Okay. So, when can we actually also create these kinds of enclave projects, right? When the selling the commodity is becoming very important for the country's economy, right. So, if there is any disruptions in selling the commodity, the country's economy will suffer. So, therefore, there will always be political support to operate the project and then sell the commodity, because in the absence of it the economy might be affected. Second is there is no alternate market for the commodity, particularly there is no market for the commodity in the domestic market. So, therefore, compulsorily the commodity will have to be exported. So, therefore, the opportunity for diversion into the local markets is going to be very minimal. So, these are some opportunities to create enclave projects. Another opportunity to mitigate the currency convertibility risk is to actually create offshore reserve accounts. So, there are, let us say specified reserve account that needs to be created to operate the project without any disruptions. If there are any sudden disruptions, ability to the reserve accounts help the company to operate this project in a continuous basis. So, one such reserve account is called as your debt service reserve account. So, that means we actually have a reserve account which is actually used to service the debtors when there are some temporary problems related to currency convertibility or transfers, right. So, if you assume that this is going to be a temporary problem, we can actually use the debt service reserve account to tide over the problems of convertibility and transfer. So, like we actually have an overseas account, we can actually create an overseas debt service reserve account, right. So, it is only the reserve account that is created overseas, but not the entire revenues that actually is in a separate overseas account. So, the reserve accounts then can be used to pay the debtors whenever there is a problem of convertibility or transfer. But what needs to be reminded here is that a reserve account will only help to overcome a temporary problem, right. If the government is going to put a blanket ban on convertibility and transfer, then having a reserve account abroad might not be a solution. But then the logic here is that any such instances is going to be only temporary rather than of more of being a permanent nature. The second type of investment risk is known as expropriation. Okay. So, what is expropriation? So, normally what we actually have is the government can take over private assets under the principle of eminent domain. Okay. See, for example, if a road needs to be constructed for the greater public good and part of the road is actually passing through a private farmland, then the government can actually acquire the farmland under the principle of eminent domain, because the infrastructure that is actually going to come up there, it is actually going to benefit a larger part of the public and it is good for the society as a whole. Okay. So, whenever the government takes over under the principle of eminent domain, they actually provide compensation for such actions. The compensation can be decided, it can be at the market value or it can be based on some negotiations between the person whose land is being acquired or whose assets are being acquired and the government. Okay. So, what is this expropriation? So, expropriation is a seizure by the host government without the payment of just compensation. Whenever the government comes away and takes over the land, but it does not compensate in a just manner, then that action is called as expropriation. Okay. So, expropriation not only means that we actually take over the assets of the company. Technically the government can also do several actions that can take control of the project company. Let us say, for example, the company is governed by the board of directors, and if the government passes an action which will enable it to represent more members in the board of directors, then the government can actually control the operations of the project company without actually taking over the assets of the company. Okay. So, we need to really remember that expropriation means any action that can actually affect the investors by taking over the assets or by taking over the control of the company. The third type of investment risk is your war and civil disturbance. Okay. So, sometimes there can be several actions that can actually disrupt the operations of the plant. It could be like internal political stability, there could be civil unrest, that can be sabotage, terrorism, there could even be a war against the host country, which can damage the project. So, today specifically if you look at, there are several countries which are having a lot of unrest in the Middle East area, like Egypt, like so many like Egypt and so many other countries in the northern part of Africa. So, whenever you actually have projects in these countries, and if you are an investor, and any such action is going to actually impact you, because the project might not be able to operate, the project might be delayed, the project assets could be destroyed and so on. Right. Sometimes after the project has begun, there could be some actions against the host government which can also affect the investors. For example, there could be a blockade or sanctions against the host government. So, whenever we have these kinds of blockades and sanctions, it can actually affect the ability of the project company to actually import equipment to the country and so on. Let us say, for example, if US has actually made a sanction against a particular government, then a project company, if it is actually planning to import an equipment from a US manufacturer, will be finding it difficult or even unable to import that equipment simply because of the sanction imposed by the US government. Okay, so this is again because of can be attributed to some level of political risk. Some amount of physical damage and the consequent loss of revenue because of some of these acts of war can be covered by insurance, but then there are so many other aspects which can which may not be able to cover under the insurance. But nevertheless, this is a significant investment risk for the project company. The second classification of political risk is what can be attributed to the change of law. Okay. So, normally if you look at investment risk, we do not see this in the case of developed countries. For example, currency convertibility and transfer risk are largely not seen in developed countries, because there they actually operate in the open foreign exchange market, and exchange rate risk is a risk, but then there is no risk in terms of currency convertibility. Then we talked about expropriation. Expropriation again is an act that we see very scarcely in the developed country. Then you have war and warlike acts. This again is normally not seen in the case of developed country. There are instances, there are exceptions, but by and large the investment risk are of concern only in the developing country, but it is not so in the case of a change of law. Okay. A change of law can occur both in developing countries as well as developed countries, and the change of law has actually a much wider application, right, and it can actually affect the project company in a variety of ways. A law can be changed after the project has been constructed. Law can change when the project is in the operation stage. So, whatever it is, when the change of law is on a retrospective basis, then even the past project will have to make additional investments to be in conformance with the new law. Okay. So, that means incurring additional investment, that means there could be a stoppage of the operations leading to a loss of revenues and so on and so forth, right. So, let us look at some examples of a change of law. Okay, let us say there is a new environmental requirement, okay, and the government can always come back and say that the environmental laws have changed and we want to make it stricter. So, therefore, the emission norms are going to be changed and so on. So, whenever such changes happen, the project company will have to make additional investments. Let us say, for example, if the emissions level has changed from, let us say, X parts per million, it has now become Y parts per million, which is a lot more stricter. So, therefore, the project company will have to make additional investments, right. So, this additional investment can actually impact the project and the returns to the investor. Okay, so, that is one example of a change of law. The second could be, let us say, imposition of price controls on companies, products and revenues. So, earlier let us say if the price has been decided on, let us say, an open market or based on some agreement between the producer and the purchaser, but the government can always come back citing the interest of the society and citing the ability of the people to pay to control the price. Okay. So, whenever the price is controlled, it is not possible to charge beyond a certain limit, and this can actually affect the profitability of the project. So, let us say this can actually be also seen in the case of a toll road. Okay. So, a toll road will generally have clauses under which prices can increase based on things like inflation and so on and so forth, but then the government can always say that the prices of the road cannot be increased beyond a certain limit, because the users of the road will find it difficult to pay. So, therefore, imposing certain kind of control on what price the company can charge. Okay. So, that can affect the revenues and the profitability of the project. And it could be increases in import duties, right. If a project will have to import a particular equipment, the government can actually go back and say earlier the import duty was 20%, and it can change the duty structure and make it 30%. So, this can actually again affect the project costing. So, these are all some manifestations of change of law and how it can actually affect the project. So, sometimes they can actually impose special taxes or levies to the project company or the industry in which it operates. Now, there are many instances where the governments are known to charge certain kind of special taxes on a particular category of industry, and that can also again impact the project. Invalidation of project contracts. Normally the project contracts will have to comply with the law of the land, and if some of the project contracts do not comply with the law of the land, and if the law has changed, then all the project contracts can be invalidated. So, remember, when you are talking about a project finance structure where the project contracts are basically the main form of security, invalidating the project contracts can tremendously have an impact on the project. You can very well imagine how severe this impact would be. A difference between an investment risk and a change of law risk is that a change of law risk generally affects the industry as a whole, but an investment risk can actually affect a particular project, right. In the case of a change of law, it may not actually discriminate against a particular project. Okay. So, again the change of law can be looked at two levels. One is a change of law that actually impact a particular industry, right. Now, whenever the costs increase because of a change of law that impacts a particular industry, let us say for example, a much stricter emission norm in the case of power plants can actually affect only the power sector. So, whenever we have a norm that affects a particular sector, the additional costs that are incurred to comply with the change of law is largely borne by the users, the end users of that particular industry. Okay. It is generally not absorbed by the project company. Let us say a change in the laws and regulations leads to a change in design, and obviously this can lead to additional costs, and the EPC contractor is not going to incur this additional costs. This additional cost is going to be passed on to the project company, and naturally the project company will not be in a position to bear this additional cost. So, the project company will then pass it on to the project off taker, right, and the off taker again will pass it on to the end consumer. So, therefore, any such change that affect the industry will naturally pass on to the end users. But then there are changes that are more of a general nature. Let us say for example, the changes in import duties, changes in tax structure as a whole, which not pertains to a particular industry, but pertains to the overall economy, or introduction of a new tax, right. So, whenever we have charges of a more general nature, it is considered as a normal risk of doing business, and it is not supposed to be passed on to the end users, right. Ultimately, there is a way in which part of it might actually get passed on to the end users, but part of which is also absorbed by the project company, because it is seen as a risk of doing business. The third category of political risk is called as a quasi political risk. So, essentially it is very difficult in many instances to distinguish between a political risk and a commercial risk. Okay. So, why do we actually have to differentiate between a political risk and a commercial risk? As we will see later, sometimes a political risk can actually be mitigated by suitable structures. You can actually cover political risk through insurance, or there can be some guarantees or the government support agreement which will kind of help to mitigate the political risk. But it is not possible to buy an insurance to mitigate the commercial risk. Commercial risk is inherent risk of doing a business. So, therefore, if you actually have a problem, if you actually have a risk where it is very difficult to distinguish whether it is a political risk or a commercial risk, it is also going to be difficult to claim insurance support should such a risk occur. So, therefore, it is very important for us to understand such quasi political risks can actually going to be very difficult to handle with. Quasi political risk can arise because of the following issues. One is it could be because of breach of contract and court decisions, okay, or it could be because of sub sovereign risk, or it could be under what is called as creeping expropriation. Okay. Let us look at each of these in some detail. Let us look at first the breach of contract and court decisions. So, breach of contract is what? So, there is a contract that has been signed by let us say a government or a government supported entity, and if this off-taker is not in a position to fulfill its obligations under the project contract. So, the project company, if it is being able to honor its terms of the contract, but if the off-taker is not able to fulfill its obligations of the contract, this is called as your breach of contract, right. If the project company is not able to honor the terms of the contract, and if the off-taker is not obliged, then it is not considered to be a breach of contract, it is considered to be a commercial dispute, right. A commercial dispute occurs when one party to the contract, essentially the project company, is not able to honor its obligations of the project contract. But a breach of contract will occur when the project company is able to fulfill its part of the contract, but the off-taker is not in a position to honor its obligations. So, that constitutes a breach of contract. So, whenever there are such a breach of contract, what is the most logical recourse? The most logical recourse to pursue will be to take it to a court of law. In several developing countries, the courts of law are not very well experienced to actually handle such contracts, and in some cases the courts can actually be also coming under political pressures. Okay. And under these circumstances, it is very difficult to determine the correctness of legal decision making or the legal judgment. So, therefore, the decisions or the judgment might also not be very objective. So, that is actually a risk. So, to avoid this kind of risk, the common practice is to actually settle these disputes in a market in a forum that is outside the host country. So, it is very common to actually see agreements where it is governed under the UK law, where the arbitration is let us say for example, in a country like Singapore. The common example is let us say the recent airport agreement that happened between Maldives and GMR, which is a company based in India. So, the arbitration was done in the court of Singapore, right, it is not done in Maldives. So, having arbitration forum that is outside the host country is seen as one possible way to kind of make the decisions independent of the local courts, because the local courts can be actually subjected to political pressure, and in order to be able to avoid the political risk, we should actually have these kinds of mechanisms outside the host country. The next category of quasi political risk is what is called as sub sovereign risk. Okay. So, political risk is always should not be considered as a risk on the central government, right. Ultimately, infrastructure projects contract with a variety of public authorities, not all of them are the central government. In many cases such as water supply and so on, the main purview of the sector is with the state government. So, therefore, if the project company signs a contract with the state government and if the state government does not honor the obligations, it is still considered as a political risk, but it is not a sovereign risk. So, risks that are due to organizations, government organizations that are not at a sovereign level, it could be state government, it could be municipalities, or it could be public sector organizations that are set up by the government. So, risk arising due to this is called as your sub-sovereign risk. So, though the government actually has a direct say in some of the organizations, let us say for example, in the case of a state electricity board, the state electricity board is virtually considered to be an arm of the government, but it is not essentially the government, right. It is essentially a public sector organization that is set up by the government, and the government does not have any liability for a company that happens to be owned by the state. Okay. So therefore, though it is possible to actually have a state guarantee for country level risk, it is going to be very difficult to handle the sub-sovereign risk, because it is actually by an organization that is not really the government, but something that is under the government. The third category is called as your creeping expropriation. Okay. What is creeping expropriation? Creeping expropriation is usually denotes actions by the government, which essentially is a way of taking action against a project company without specifically repudiating contractual obligations. So, it is essentially making the life very difficult for the project company. The government can actually do a variety of things. Let us say for example, the government can actually be very slow in issuing permits, right. For example, it can hold up exports or imports at the docks, citing some procedural issue or the other, right. Or it can actually make an inquiry for some tax offences, correct, or it can lead to something that can be leading to lengthy investigations. So, these are all issues which can actually create a lot of discomfort, it can actually create a lot of hurdles for the project company. Okay. So, in essence it actually deprives the investors the real benefit of the project. Okay. So, without individually, let us say for example, individually each of these actions cannot really have any major impact, right. All things being equal, if the government is being slow in issuing permits, the process can be accelerated through a negotiation process. But then if the government does a lot of things, let us delays in issuing permits, holding up exports and imports, and then starting off investigations and so on, cumulatively all of this can actually lead to an impact on the benefit of the project. So, before we end this, the thought question is, what are the problems with actions that can be termed as creeping expropriation, okay? And why is this such a difficult thing to handle? Right? So, we will discuss about it in the next lecture.